Welcome to this session. In this session and in the subsequent session, we will discuss the structure and further development in the banking industry. So, in the previous sessions, we completed the discussion of what is banks and what are the various activities of banks, especially by using its balance sheet. And in this session, let us start now with some of the banking activities without using balance sheet. That means some of the off balance sheet activities. So, the off balance sheet activities involve trading financial instruments and generating income from fees and loan sales, and activities that affect bank profits but they do not appear on bank balance sheets. So, there are a couple of activities that do not come under off balance sheet activities. One of them is loan sales. Is also called as secondary loan participation. So, the loan sales has grown in importance in recent years as it involves income generated by loan sales. So, a loan sales involves a contract that sells all or part of the cash stream from a specific loan and thereby removes the loan so that it is no longer an asset on the bank's balance sheet. And banks earn profits by selling loans for amounts that are slightly greater than the amounts of the original loans, right. So, the point here is that actually some of the banks they are able to attract lots of loans. So, what they do that in order to minimize optimize their activity, some of the loans they will sell it off. They are able to raise their loan and some of the loans they will sell it off, and but by selling they will be selling it slightly greater than the amounts of the original loans. So, those who will buy it actually, because the high interest rate on these loans make them attractive. Maybe some banks they are able to attract a large amount of loans, and the high interest rate on these loans make them attractive, and some institutions, some financial institutions are willing to buy them, and since maybe they are unable to raise this kind of this amount of loans by their own. So, what they will do that they will find it as a business opportunity, and this is some other institution, financial institutions are willing to buy them, preferable of course it is greater than higher price, at a higher price that they earn a slightly lower interest rate than the original interest rate on them. So, approximately the difference will be 0.15 percentage point difference. This will be the difference in the interest rate at which other institutions are willing to buy it. So, that means the difference. So, the new institutions, when they buy these loans, they will be getting slightly lower profit, less return as compared to the original seller here. Okay, so this is one kind of activities of balance sheet activities. Then comes the second one is generation of fee income for providing specialized services to their customers, servicing a mortgage backed security. So, there are several examples for that. One is foreign exchange trades on customers' behalf. That is one. So, in this activity, through this foreign exchange trade, banks make fee income which do not come under it. It will not be reported. This activity will not be reported in the balance sheet. And servicing mortgage backed securities, that is collecting interest and principal payments and then paying them out, that is another kind of services. And banks also provide backup lines of credit. As we have seen that in one of the previous session, we said that in order to reduce moral hazard problems, in order to monitor, banks make loan commitment. So, here the loan commitment it come with a fee. That means the bank agrees to provide a loan up to a given dollar amount over a specified period of time. Right. So, through committing this, the bank is gaining a fee, and there is also credit lines with the overdraft privilege. That means the customers they can overdraw than the amount they are having in their current account. So the credit lines with overdraft privileges that also earn some income. And then comes creating structured investment vehicles. So an SIV is a pool of investment assets that attempts to profit from credit spreads between short-term debt and long-term structured finance products such as asset-backed securities. So that means creating that SIVs, that means borrowing from short, so many short-term borrowing, then putting everything, most of them clubbing all together into different financial product, that is making investment in another financial products. So in this process also banks can make profit, they can earn additional income. So however, you know that it can potentially expose banks to risk as it happened in the global financial crisis. The way it was done in 2007-8 crisis, that the mortgage loan, so what was done that actually so many individual mortgage loans and were converted into a structured financial product and made it as a look like entirely different financial product, then it was sold out in the market. However, you know that was one of the main reason for the 2007-8 crisis. Coming to further activities, also includes trading activities and risk management techniques. So to manage interest rate risk, banks often engage in off-balance sheet activities such as trading in financial futures, options for debt instruments, and interest rate swaps. And bank engaged in international banking also conduct transaction in the foreign exchange market. So sometimes this kind of speculation can also be very risky business and has often led to bank insolvencies in many cases. It also lead to principal agent problems. That means a kind of conflict of interest come up when banks engage in trading activities and risk management. So there are some, in order to overcome that kind of conflict of interest, there are several tools are recommended, suggested, and these actually we will discuss this one in detail when we discuss in one of the session the conflict of interest and asymmetric information. However, shortly here so some of the tools to reduce this conflict of interest is separation of trading activities and bookkeeping, limits on exposure and value at risk, that the maximum loss that its portfolio is likely to sustain over a given time interval. So these concepts, these issues which I just mentioned here, as I mentioned, we will be discussing these in detail in some of the forthcoming sessions. So let's now move to continue our discussion to another area, that is the structure and operation of the banking industry over time. The operations of individual banks, how they acquire, use and manage funds to make profit, are roughly similar throughout the world in fact. So in all countries, banks means normally like this: they accept a deposit from the general public and lend to the needy people, including households and firms. And in all countries, banks are financial intermediaries in the business and they earn profit. They are just like any other firm. However, because of the kind of business they are doing, that accepting deposit and lending loans, because of the kind of activities, banking business is different from the rest of the business, right? So in most countries, however, what we can see that recently, if you go through the banking, the number of number of banks in countries, you can see that in most countries a few large banks typically dominate the banking industry. So for example, in India, you know that there are only there are 36 commercial banks. So out of this, you know that a few banks they dominate, right? For example, SBI, HDFC, these are the large banks, they dominate in the market. For example, SBI is the largest commercial bank in India. And however, in the case when it comes to, for example, what I mentioned here is that in India there are only 36 commercial banks, scheduled commercial banks, and nearly 46 banks, 46 foreign banks working in India. So as compared to this, if you look at United States, we can see that there are on the order of 5,700 commercial banks, 800 savings and loan associations, and 350 mutual savings banks, and more than 7,000 credit unions. So here is a natural question is that, because look at, for example, in the US there are large number of banks, but in India there are only a few number of banks. So does this diversity, for example, in the US system, the American banking system is more competitive and therefore more economically efficient and sound than banking system in India and other countries. So in order to understand this, let us see how the structure, the structure and operation of the banking industry in the Western settings as well as in India, and how over time the structure has changed. What are the changes happen over time? So one of the thing happened in recent years is that financial innovation and the growth of the shadow banking system. In recent years, the traditional banking business of making loans that are funded by deposits has been in decline. That is one of the recent development for the last more than last 2 decades. Some of this business has been replaced by shadow banking system, in which bank lending has been replaced by lending via securities market with the involvement of several different financial institutions. So the process of financial innovation, actually the financial innovation transformed the entire financial system. Like other industries, the financial industry is in business, as you know, to earn profits by selling its products, right? So their objective is also just like other firms, to maximize their profits. Financial institution, in order to maximize financial institutions, they develop new products to satisfy their own needs as well as of their customers. In other words, innovation. So that is financial innovation, which can be extremely beneficial to economy. That is the desire, and it is driven by the desire to get to earn more profit by these banks. So financial innovation, as I mentioned, this is driven by the desire to earn profits. So a change in the financial environment will stimulate a search by financial institutions and for innovations that are likely to be profitable. So starting in the 1960s, individuals and financial institutions operating in the financial markets were confronted with the drastic changes in the economic environment. So one of it is actually the inflation and interest rates climbed sharply and became harder to predict, a situation that changed demand condition in financial market. The inflation risk and the interest rate risk became one of the key challenges for the banking industry. So in order to overcome this, they started thinking alternative options. In addition, in parallel, you know that the rapid advances in the computer technology that changed the supply conditions in the market. In addition, financial regulations became more burdensome. So because of all these things, you know that some of these things are in favorable, some of the things are, especially financial regulations, it will become very burdensome. So because of all these things, eventually, naturally, gradually, banking system began to look for financial innovation. And the financial institution found that many of the old ways of doing business were no longer profitable. Many financial intermediaries found that they were no longer able to acquire funds with their traditional financial instruments, and without these funds they would soon be out of business. So in order to survive in the new economic environment, financial institutions had to research and develop new products and services that would meet customer needs and prove profitable. And this process is often referred to as financial engineering. So a financial engineering, this process started due to these pressing concerns. So financial engineering, it led to an explosion in derivative tradings and speculation in the financial market. On the one hand, we can see that the financial engineering it revolutionized the financial markets, but at the same time it also played a role in the 2008 crisis. In one of the session we will study the financial crisis, the There is theoretical background as well as the practical aspects we will be discussing in one of the session, and at that time we will also see how financial engineering contributed to the collapse of financial system in 2008. So, one of the responses to changes in demand condition, because one of the risk that the banking system often face is the interest rate volatility. So, the most significant change in the economic environment that altered the demand for financial products in recent years has been the dramatic increase in the volatility of interest rate. So, large fluctuations in the interest rate lead to the substantial capital gains or losses, because in one of the session we discussed previous session we discussed the interest rate risk management. At that time, using the gap analysis, we have seen how the net worth of the bank will increase or decrease due to fluctuations in interest rate. So, this actually created greater uncertainty about the returns on investments. So, in order to overcome this, financial institutions find that lending is more attractive if interest rate risk is lower. So, in order to address this issue, they started using following adjustable rate mortgages. So, the adjustable rate mortgage, for example, an adjustable rate mortgage might have initially one fixed rate of interest. However, when the market rate of interest changes, the adjustable rate mortgage also change the interest rate in flow with the market rate of interest. That means flexible interest rate keep profits high when rates high. So, lower initial interest rates make them attractive to home buyers. So, this attractive feature, because the adjustable rate mortgage allow mortgage issuing institutions to earn higher interest rates on existing mortgages when market rates rise and profits remain high during this period. This attractive feature of adjustable rate mortgage has encouraged mortgage issuing institution to issue adjustable rate mortgages with lower initial interest rates than those on conventional fixed rate mortgages, making them popular with many households. Then another innovation is financial derivatives. So, financial here, given the greater demand for the reduction of interest rate risk, commodity exchanges such as Chicago Board of Trade recognize that if they could develop a product that could help investors and financial institutions to protect themselves or hedge interest rate risk, then they could make profit by selling these instruments. So, this includes the future contracts in which the seller agrees to provide a certain standardized commodity to the buyer on a specific future date at an agreed price had been around for a long time. Then let us also see what are the responses to changes in supply condition, that is due to the changes to the response to the changes in information technology. So, the most important source of the changes in supply conditions that stimulated financial innovation has been the improvement in computer and telecommunication technology, which is often called as information technology. So, it had two effects. First, it has lowered the cost of processing financial transaction, as you know, so making it profitable for financial institutions to create new financial products and services for the public. And second, another thing, it has made it easier for investors to acquire information, thereby making it easier for firms to issue securities. So, the rapid development in IT, it has resulted in many new financial products and services. So, one of them is, actually you may be familiar, you are so familiar, that one is a credit card and debit card. And you know that the credit card have been around since long back, even before World War II. So, however, it became more popular recently after the due to the development in information technology. And the debit card also, you know that your ATM card in shortly. So, these are all actually you can make a transaction using information technology very easily, right. So, for example, credit card, I think You are aware of what is credit card. So a firm issuing credit cards earns income from loans it makes to credit card holders and from payments made by stores on credit card purchases. Right, that the commission amount it vary from country to country and providers to providers. And however, anyway, the thing is that it has actually made contributed to the in the transaction and the financial transaction made very smooth, and as a result, the customers, the households, consumers, and sellers found it is very convenient. So it actually also raised the bank's business as well. That is one. And subsequent part that you are well aware that actually the developments in electronic banking, that the ATM or automatic teller machines and home banking and virtual banking. So automatic teller machine, I think you are aware of that. Actually one important form, this is a e-banking facility, an electronic machine that allows customers to get cash, make deposit, transfer funds from one account to another and check balances, right. And because of ATMs, also one of the advantage of ATM is that because of their low cost, ATMs can be put at location other than a bank or its branches. Actually, even that means actually having branches without actually having a branch. You can see the ATM wherever ATM. So it's actually serve the purpose of a bank branch indeed. Actually no need of a branch itself. Then comes home banking. Is now cost effective for banks to set up electronic banking facility in which bank's customer is linked up with the bank's computer and allowed to carry out transaction by using smartphone, tablet or personal computer. Then another development is virtual bank. Virtual bank means a new type of banking institution, a bank that has no physical location but rather exists only in cyberspace. Then another development is junk bonds. Before the advent of computers and advanced telecommunication, it was difficult to acquire information about the financial situation of firms that might want to sell securities. Because the difficulty in screening out bad from good credit risk, the only firms that were able to sell bonds were very well established corporations that had high ratings. Some firms, that before 1980s, only corporations that could issue bonds with rating BAA or above could raise funds by selling newly issued bonds. Some firms that had fallen on bad times, which also known as fallen angels, had previously issued long-term corporate bonds with ratings that are now fallen below BAA, bonds that were also known as junk bonds. So with the improvement of information technology, it became easier for investors to acquire financial information about corporations, making it easier to screen out bad from good risk. So with easier screening, investors were more willing to buy long-term debt securities from less well-known corporations with a lower credit ratings. So that means with this change in supply condition, one would expect that some smart individual would pioneer the concept of selling new public issues of junk bonds, not for fallen angels but for companies that had not yet achieved investment grade status. And another development is commercial paper market. Commercial paper is a short-term debt security issued by large banks and corporations. That was also possible due to the development in changes in supply condition, that is changes in information technology. Further development, one is securitization and shadow banking system. So securitization means to transform otherwise illiquid financial assets into marketable capital market securities that can be sold to investors. That means transforming illiquid, say due to dues from a borrower, this kind of assets are converted into marketable capital markets securities. So this kind of things happen very much in the 2007-8 crisis. So securitization played an especially prominent role in the development of the subprime mortgage market in the mid 2000s. Then another development happened is, in order to avoid existing regulation, that means loophole mining, two sets of regulation have that also another development. That means banking sector responding to avoid the regulation. So there were two regulations mainly. One regulation is that reserve requirements of the banks. That means of the total deposit liabilities, a certain fraction should be kept with the central bank. So that means they cannot lend their entire deposit to the in the market. That means certain portion it should be kept with the central bank as reserve requirement. That is one. Second one is restriction on interest paid on deposits. There is certain threshold, beyond that they cannot pay. That means maximum limits on the interest rate that could be paid on time deposits. These are the two regulations. In order to overcome, two developments happen. One is actually the development of money market mutual funds. So money market mutual funds issue shares that are redeemable at a fixed price. Money market fund, they raise fund from investor and invest in short term money market securities like treasury bills, negotiable certificates of deposits, commercial paper, etc., and that provide them interest. So they earn a profit, and at the same time you know that this cannot be considered as deposit, so that they don't need to keep a reserve with the central bank. Second one is sweep accounts, development of sweep accounts. So in the sweep account arrangement, any balance above a certain amount in a corporation's checking account at the end of a business day are swept out of the account and invested in overnight securities that pay interest. So because the swept account funds are no longer classified as checkable deposits, they are not subject to reserve requirements and thus are not taxed. So that means because of sweep accounts, whichever is kept in the sweep accounts, it will not be considered as deposit liability. So there is no need of keeping certain fraction of it in the central bank. Then there is further financial innovation. There was a decline in traditional banking, so that they have started raising money from off balance sheet activities. So one, the financial innovation, the decline in traditional banking. One is decline in cost advantages in acquiring funds, and second one, decline in income advantage on users of funds. So these all the further developments in the banking sector over time. So we have covered here mainly the various aspects, that the development of banking over time, the structure, and the means mainly the structure in terms of how financial innovation happened, what kind of financial innovation, what is the response of banking industry in terms of banking innovations, and how in order to earn more profits. These are all the, and also as a response to supply conditions, that is IT, what all the changes happened in the banking sector over time. So here the discussion we overall just had mostly with the developed countries context, but that is most of them are generalizable to the across the globe, other country settings as well. So in the next session we will continue this, then we will discuss the banking structure in India as well. Thank you, and see you in the next session.